Hello, my name's Kevin Uphill. I'm the chairman of Avondale Corporate, an international mergers and acquisitions strategy specialist. Today I'm joined by Mike Cooper, tax partner and of Moore Stephens, a global accountancy firm. And we're going to be looking at, as well as how you have a prepared asset when selling a business, a key part of a prepared asset is also looking at the accounting regulations and the tax position when looking at exit strategies. Welcome, Mike.
Hi, thanks Kevin, and welcome to all. The title of the talk is How to Increase Your Value and Sell or Buy a Company, and it's an introduction to tax issues. That means we'll be covering the most important points that typically come to the fore in deals from both a buying and selling perspective, but we won't be covering every scenario. So let's have a look at the overview. We're going to be covering three basic scenarios. We're going to be looking at selling a company. We're going to be covering the basics, the importance of claiming entrepreneurs relief, which is basically the 10% rate of tax. We're going to be covering the new investors relief briefly, which was introduced in April. We're going to talk about the pre-sale structuring and some general planning points for the sellers. We're also going to look at buying a company, and again we're going to look at the basics. We're going to look at the importance of structuring the purchase, and we're going to be looking at employment tax issues, which are specific risks for the buyers, and we're going to be looking at financing the purchase and touching on enterprise investment scheme and investors relief issues in relation to that. Finally, we're going to talk about the post-sale tax issues that particularly affect vendors post-deal. And one of the reasons why we're mixing the selling and the buying processes is because the buyers and sellers both need to understand where the other side is coming from in a deal. It's important from the point of view of negotiations. It's also important to buyers because, of course, they're the sellers of tomorrow. So they need to also have a weather eye on exactly what they're doing with a view to a future exit. Finally, in terms of takeaways from this talk, one would hope that at the end of this you'll be in a better position to understand that there are good ways and bad ways of doing deals, particularly for vendors, in order to achieve the same commercial objectives. The tax effects can be radically different depending on how you approach a deal. Okay, let's look at the selling overview. And we've split this into three distinct areas. One is pre-sale, one is the deal process itself, and finally we're looking at post-sale issues. We're going to spend most of our time in the talk on pre-sale issues because this is where the most value can be obtained, and this is where you will need to understand the issues and the positioning you need to adopt prior to making a disposal. We're then going to move on briefly onto the deal process itself, where we're going to look at the types of issues that crop up right at the end of the process when there are typically many last-minute changes to a deal, and how does that affect your tax status going forwards. Typically this is all around changes to the way in which the consideration is structured or changes to warranted and indemnity clauses, but you need to be fairly light on your feet when dealing with these issues. On the post-sale issues, we'll be talking about mainly the new tax challenges that you will face as a vendor, primarily inheritance tax, and we're going to look at the importance of doing the tax returns correctly. The first and possibly the most important slide for any vendor is the importance of understanding the difference between a share and an asset sale. There are two different ways in which you could sell your business. One is via a share sale, i.e. you're going to sell the company and all its contents, assets and liabilities, lock, stock and barrel to a third party. It's a single transaction. The alternative and a much less common, and you'll find out why in a minute, much less common way of doing this is to sell the assets and possibly some of the liabilities out of the company itself. So you'll be left with a company with cash in it, and then you'll extract the cash normally by way of liquidation or some form of distribution. Now, if you're looking at the share sale first, you can see that this gives rise to a single level of taxation. You've got a tax charge on the disposal of the shares, and assuming that you qualify for entrepreneurs relief, which will come on to the qualification conditions for that in due course, but assuming you qualify for entrepreneurs relief, you would expect to pay no more than 10% capital gains tax on that. Now, this is the holy grail of tax planning around the sale of owner-managed businesses, and this is what we spend as tax advisors an awful lot of our time doing, making sure that you do qualify for the entrepreneurs relief, and if there are any problems, dealing with those problems. The good news is that the highest rate on the share sale now is 20%. It's come down from 28% unexpectedly. George Osborne changed this as his final act as Chancellor, as it turned out, and that's now 20% as opposed to 28%. So that's a welcome news. It's welcome news, but nevertheless, there's still a 10% spread there between the lower rate with ER and the higher rate without ER. So it's still worth making sure you get your entitlement to entrepreneurs relief. Okay, now let's compare that share sale position with the asset sale liquidation position. Now here you've got a double taxation charge. This is because the company itself is selling the assets and liabilities, and that will give rise to a corporation tax charge. And then, of course, you've got to extract the funds from the company, and that's going to give rise to a capital gains tax charge on the liquidation, or worse than that, an income tax charge, which is at a higher rate of tax. So again, looking at the bottom brick in that wall, your lowest rate of tax under the asset sale route is 28%. So that's 8% higher than the highest rate under the share sale, and it could go as high as 50%. So as you can see, to achieve the same commercial objective of selling your business, you could have a tax differential between 10 and 50%. To put this into context in an example, say you're selling your business for £2.5 million. Under a share sale route, you'd be expecting to pay £250,000, being 10% of the proceeds stroke gain made in that transaction, which would not be untypical. So £250,000 tax charge. Now look at the asset sale route. You could be paying between 28% or £700,000, or 50% in the worst case scenario, which is £1.25 million in tax.
Right, given that taxation gap, most of our clients, in fact nearly all of our deals are share sales. I can't remember the last time we did an asset and goodwill deal. Why would anyone use an asset and goodwill deal? I
think the people that would use an asset sale deal are normally people who are in a weak position often. Either there's a problem with the company itself, it's got losses, or it's got pension fund deficits perhaps, and they're kind of on the back foot often. And what the buyer will do, sensing the weakness in this sort of buyer, will say, actually, I don't need your company, I don't want your company, it's got issues, it could even have an investment property in there that is unwanted, and it forces the vendor down an asset sale route. So the vendor may reluctantly accept that an asset sale route is the only way forward, simply because of the problems that are existing in that company. But I would argue that there are, even in that scenario, there are probably better ways of doing that particular deal. Does that answer your question?
That's certainly our experience.
Okay. But I would agree with you. Our experience is that 90 to 95% of all deals are share sale deals, and this explains why.
But when you sell companies, you can also offset the costs of selling it against that 10% tax. tax.
Yes, you can.
So you could net that off the 10%.
Absolutely, yes. The brokerage costs, the advisory costs can, in the most part, be offset against the the proceeds of the deal. Okay, let's look at a nasty little wrinkle that occurred on 6th of April 2016. This was introduced by George Osborne, again in his final act as Chancellor, and it affects liquidations. And referring back to the previous slide when we were talking about asset sales and liquidations, this is not an unusual scenario now. There could be a situation where somebody liquidates the company and ends up paying 50% of tax. And the reason for that is they've introduced a new targeted anti-avoidance rule, catchily named, and it's more commonly known as the TAR in the trade. And this is aimed at serial or stroke Phoenix activities, which are carried on within 2 years after a previous company has been closed down. And what this is aiming at to stop is serial entrepreneurs who are just buying and setting up companies and then liquidating them, getting their money out at 10%, and then moving on with effectively the same trade and doing it again and again and again, and getting their money out at 10% when everyone else is getting their money out at 38% income tax. So what the government is saying is we're not happy with people doing that, so we're going to target avoidance, they call avoidance activity, and we will seek to tax those transactions at 38%. What that means is the effective rate of tax will get you into that 50% band that we were talking about in the previous slide, which is where you do not want to be. The short lesson from this, from the previous slide and from this, is that you need, in 95% of all cases, to do a share sale deal, and you will avoid both the TAR and the other issues. So if you go over nothing else, you need to do a share sale deal. Okay, now let's look at what you need to do and what your company needs to do to qualify for entrepreneurs relief. Now remember, entrepreneurs relief is shorthand for getting the 10% rate of tax. This, as I said, is the cornerstone or the holy grail of tax planning in relation to OMB companies. So what are the main qualifying conditions? And as you can see from the stepping stone diagram, there are a number of conditions which all need to be satisfied to get to that 10% goal. First of all, your company needs to be a trading company. Now, I can hear a lot of you saying, well, that's a tick in that box because we've definitely got a trading company. Unfortunately, this is an HMRC definition of what a trading company is. And basically what the revenue say is that a company which is at least 80% trading will qualify as a trading company. Well, that's the good news. Another less positive way of putting it is if more than 20% of the activity is non-trading in nature, then it won't qualify. So you're now going, ooh, that may give me a slight problem. What sort of activities might cause it to be non-trading? Well, holding surplus cash. We've got, I've seen a number of clients over the years who, because they didn't want to distribute their cash, have kept the cash within the company for various reasons. The revenue are getting increasingly difficult about surplus cash and are asking increasing number of questions in relation to that.
But of course, Mike, one of the key pieces of planning people are doing is leaving the reserves in the business and trying to sell that at 10%, and we've been doing that a lot recently. Are you saying that's up for grabs or going to become increasingly more difficult?
I think it's going to become. There is some evidence from recent dealings with revenue that they will be looking more closely at surplus cash. Indeed, in the autumn statement last year, 2015, there was a suggested measure, which wasn't actually enacted, was that they were going to go back to taxing money box companies as if the cash held was going to be subject to 38% tax, even though it hadn't been distributed. Now, they didn't go forward with that measure, but it's clearly on the revenue's radar.
But this is something I just, to take you up on that, have a bet with a client that it'll be easier for them to change 10% rate or bring the bar down from 10 million to 5 million, because how do you define what a money box company is or what is surplus cash? I mean, that's a big debate.
It is a big debate, and unfortunately that's one of the uncertainties in relation to this area. I mean, the good news is you can go to the revenue and get a ruling in respect of, if you're in any doubt as to whether your company is a trading company, you can go to the revenue and get a ruling. Now, that sounds all very desirable and good. Unfortunately, you may not get the answer that you want from the revenue. And whilst that may be valuable assurance either way, it can also give you problems if the answer is a big fat negative. Another area that can cause problems in respect of not qualifying as a trading company is where you hold investment property, and that can also, and that's quite common, you've either got surplus commercial property or perhaps you've invested surplus funds in residential property. And there are a number of companies, particularly older companies, who have done this in the past for perfectly good commercial reasons. But unfortunately, it starts unraveling when you're thinking of selling your company, because you may not get your entitlement to entrepreneurs relief. So that's probably the most important condition, as the trading company says, and it's the one that's often misunderstood. You also, if you're going to be a successful vendor and qualify for ER, you need to have at least 5% of the shares, ordinary shares, and voting rights in the company. Well, for the vast majority of entrepreneurs, owner managers, that's not going to be a problem. They'll probably control their companies. But it can cause problems. A typical sort of scenario is where a director has given his or her spouse some shares, typically for income tax planning purposes, to give them a level of income from the company, and they perhaps got 5% or less than 5% of the shares. It can also affect some employee shareholders who may have 1 or 2, typically 1 or 2% in the company. Those people will not qualify for entrepreneurs relief. So sometimes you may need to make some adjustment regarding those shares in order to qualify for the entrepreneurs relief, either by transferring them back to the spouse, or perhaps by having awarding the employees via EMI share options, which I'll discuss a tiny bit further on. The third condition, and probably the easiest one to deal with, is that each vendor must also be, as well as being a shareholder, must also be an employee or an officer of the company. And again, this is a condition that can often catch out, say, spouses who are perhaps not employees and are not a director or a company secretary of a company, and they need to be made a director or employee of the company. Now, all these three conditions have to be satisfied for at least 12 months immediately prior to disposal. So this is not something you can sort out at the last minute. You do need to sort this out well in advance of the sale so that you can secure your 10% rate of tax. As I mentioned before, ER is worth a lot of money. It's worth, the actual lifetime entitlement is £10 million per person in respect of the relief, and the differential between the higher rate of CGT and the lower rate of CGT is 10%, so that's 10% of 10 million. That's worth up to £1 million per person. So in a four-man company, we've got £4 million worth of tax relief at stake here. So it's big numbers. I mentioned up above that one of the ways around the 5% voting rule is to acquire your shares via enterprise management incentive share option scheme. This is a tax incentivized scheme sponsored by the HM Revenue and Customs. If you acquire your shares, albeit under the 5% threshold via the EMI scheme, then you will qualify. Notwithstanding the fact that you have less than 5%, you will still qualify for ER. So it's a very neat way of achieving getting around the 5% rule. We talked about getting a trading status ruling from HMRC. Yes, it's a finely balanced tactical decision as to whether you go for a ruling, but it does have the great advantage of giving you assurance up front. Finally, do take care if a company has interest in minority joint venture stakes. I'm not talking about subsidiary relationships, the old group relationships. I'm talking about, say having a 25% stake in a joint venture company or 50% share with another party. Those joint venture relationships can end up tainting the trading company status, and you may need to deal with those joint ventures or sell those joint ventures prior, and at least 12 months prior to disposing of the main trading company, so that you don't fall foul of what can be quite nasty joint venture rules. And again, this all takes time to prepare for, and you need to be doing this probably considering this at least 18 months prior to disposal. Okay, good. We've talked about entrepreneurs relief. A new relief, which was introduced again by George Osborne with effect from 6th of April 2016, is what's called the new investors relief. And this is aimed at business angels rather than full-time entrepreneurs. So it's those people who are investing in companies and putting in new money into companies, but who are not going to be employees, at least initially, of the companies, and they're not going to be officers of the companies. They're going to be true investors, and they're going to be putting new money in. For these people, they may also be entitled to a 10% rate of tax via what is called the new investors relief. And once again, there are some fairly familiar conditions attached to qualifying for that relief. First of all, it needs to be an unlisted trading company. Again, that's very similar to the entrepreneurs relief requirements, and in fact the tests are very similar under entrepreneurs relief. Now, there's no 5% requirement, but you do in relation to shareholdings, but you do need to own ordinary shares in the company, but there's no 5% requirement. You cannot be an employee or officer of this company for the first 6 months. There can be no intention to be an employee at the time you put your money in as an investor. This is very important and distinguishes it from entrepreneurs relief. So in other words, you won't be able to get entrepreneurs relief and investors relief on the same investment. And again, these conditions have to be satisfied for a period of time, but in this case for investors relief it's at least 36 months with effect from 6th of April 16. So this investors relief is not going to be effective for disposals until at least 6th of April 2019, because this relief won't come into effect until then. But it's something that new investors need to keep a weather eye on. Okay, now let's look at a fairly typical scenario, bearing in mind both the requirements for qualifying for entrepreneurs relief and for investors relief. What sort of scenarios are we looking at that you would recognise as being problematic for shareholders? Well, let's take the fairly typical scenario where you've got shareholders owning one company. It's got both a property and a trade in that company. Now, what's wrong with that? Well, there's nothing wrong with that if that's, say, a factory and you're a manufacturing company. So you'll obviously be selling the company with its manufacturing capacity, and the property would go with that trade. However, let's have another look at a different scenario. Let's have a look at, say, a service company business where the vendor is really only interested in acquiring the customer lines, perhaps one or two key people in the business. They're not interested in the property. They've got their own property. They're not interested in financing the property, and perhaps their bank won't even give them finance for acquiring that property. Or perhaps look at another scenario is where that property is actually surplus to trading requirements, or maybe completely unrelated to the business, maybe a residential property. So you've got a scenario there where to get that sale away, typically you would be doing an asset sale, and the alarm bells are already ringing here because you're now into the 28% to 50% bracket. You don't want to do an asset sale, you want to do a share sale deal. So how are you going to convert this situation into a much more tax-friendly structure? Well, there are two scenarios, and one is what I would call a halfway house scenario solution, which is the group structure in the middle, whereby you set up a holding company on top of the existing company, and you then hive down the property and the trade into two subsidiaries. So you've then got a fairly simple group structure with three companies in it, the holding company, the property company, and the trading company. That at least enables you to sell the trading company off and possibly pay no tax at that point, because the money then goes into the holding company. But the reason why that's only a halfway house solution is, yes, you've managed to dispose of the company. You may not have paid any tax at that point, and you haven't got a double taxation charge, but you've still got money tied up in the company. And to get that out and keep the property, you're probably going to be paying 38% tax to get that out, which is not a good scenario. The better solution in the majority of cases is you move to a full, what's called demerger of the property and the trading company interest. And basically what you're doing here, it's quite a complicated process, but the essential outcome is you're separating out into two completely separate property companies and trading companies. And this will enable you to sell your trading company straight back to the shareholders and retain your 10% rate of tax, hopefully. Now, if you're in a scenario where the original company was tainted, then you may have to wait 12 months before you actually do the sale, because remember, you've got that 12-month waiting rule. But you're in a much better position if you've done the planning in advance and you are able to sell the trade and get that 10%. Now, obviously, in terms of costs, leaving it as it is the cheapest way, but it's going to be very expensive in terms of tax. But the demerger is often the most tax-efficient way of securing your 10%. So do think carefully about restructuring issues if you've got a problem with your ER identified right at the planning stage. Okay, now we're going to move on to the deal process. And the most important aspect of the deal process is to identify how exactly it is you're going to be paid, i.e. what is the form of consideration that you're going to take from the deal. Typically, there'll be a large element, probably the majority element, will be paid in cash and possibly up front, maybe deferred. But it's when you get onto the deferred consideration that you start entering into potential areas of tax complexity. If the deferred consideration is purely in terms of deferred cash or simple loans, i.e. they're going to pay you in 1 or 2 years' time, there should be no adverse impact on entrepreneurs' relief because it's a simple cash deal, albeit deferred. However, many deals, and I think, Kevin, you're familiar with this, may have an element of loan notes, deferred consideration, or even taking new shares out in the buying company. Now, the vendor in those situations he won't be paying tax necessarily, but particularly in respect of loan notes, when he comes to redeem those loan notes, unfortunately he'll find that he doesn't pay tax at 10% because he's missed the boat on that. He's going to be paying tax at 20%. So one of the options available to vendors in this situation is they can actually opt to pay the tax early. And this is where the structure of the deal is quite important, because obviously if you're going to pay the tax on the whole consideration early, then you've got to have enough cash to pay that tax by the 31st of January following the tax year in which you make the disposal. So you can taxpayers can elect to pay all the tax up front, but the downside is that you've got to pay all the tax on all the consideration, even though you haven't received it. So there have been scenarios with some of my clients where they've actually had to take quite a finely balanced decision, because particularly where shares are given as consideration, and the value of those shares, if those value of those shares are not expected to be high in the future, then you may not want to elect to pay all the tax, and even under the ER provisions.
Mike, we've had a question in on this.
Yes.
We've got a client here clearly being advised to wait until after April. We've got a small earn-out, wait until after April, so they have a longer period before they have to pay that tax. Is that right? How does that work?
Yeah, absolutely. Yes. I mean, you can defer. Typically this is with the deals that are taking place or coming to fruition in, say, February, March of any given year. Remember, the tax year end is 5th of April each year. So there are often occasions when we say to clients, actually, do you want to defer the exchange of contracts until the 6th of April? That will give you a further year in which to pay the tax liability. Now, the downside risk of doing that is, of course, the Chancellor's budget is also announced in March, and they may raise the tax rates. But normally you get advance notice of that, so you may have the option, should have time to have the option to exchange pre-5th of April in that sort of scenario. But it's not always good news. In fact, I've got one or two clients who were a bit disappointed because they'd done a deal at 28% last year and found out that unexpectedly the Chancellor reduced the tax rate to 20%. So
to the usual tax lottery.
Yes. Yeah.
Thank you.
Okay. Sundry issues. Moving on to sundry issues affecting the sellers. First of all, calculate the plan for the tax liability. It's a big number. This will be the biggest cost of the deal and can make or break deals. So work that out in advance. Buy out non-contributing minorities. Do have a look at whether it's possible to buy out minority shareholders who may be very happy to receive cash in advance of a sale, or well in advance of a sale. And you can make that tax efficient for them. It can be remunerative and value-adding for you, but you need to consider those tax implications up front. Extracting surplus funds in advance. We've talked about building up, Kevin's already talked about building up surplus cash in the business. And providing the revenue doesn't object to that, that's fairly good tax planning. But you can also have that money out either by way of bonus or by way of dividend, or you could have it by way of a loan as a direct loan account, which means that when you come to a sale, if you go the direct loan account route, you can pay 10% capital gains tax instead of 38% or 47% on a bonus or a dividend. So if you are thinking of doing a deal, then do think about how you're remunerating yourself in the meantime, because there could be big tax savings there. Claiming unused reliefs. Do remember that these reliefs are yours until you come to sell your company. The typical examples and we've got two on the side here, R&D tax relief and capital allowances. There are any number of companies, and I've lost track of these, Kevin, a number of companies who don't actually claim all the R&D tax credits to which they're entitled. This is roughly worth 25% of any qualifying R&D spend that your company spends on remunerating people who are engaged in qualifying R&D activity. And this is money that the government will give you, your company. If you sell the company on...
I just want to interject there, Mike, because we see this time and time again. You talk to clients, they say they're claiming the R&D reliefs, their accountants have advised them a bit, but our experience is they're nowhere near aggressive enough about who's been contributing to R&D, and we're leaving money free in the company for the buyers to benefit from because they won't look at it. They've left it too late. Is that your experience as well?
Yes, I think they do leave it too late, and you know, often they've been many years without claiming R&D tax credit or capital allowances or losses for that matter. All I would say to them is if they've got assurance from their advisors, there's no harm in having a second opinion.
It costs nothing for second opinion. We've had some clients where we've done that and got big checks, 35, 50 grand that we weren't expecting.
Absolutely, and more, and you know, just because a claim has been made does not mean you've maximised it.
That's
so
right.
Always get and do go to a specialist in respect to this, because it's a complex area of tax relief.
But the work itself is quite simple, so it doesn't take a lot of resources internally to do it, does it?
Absolutely not. No, it's basically a half. It's a couple of hours of asking questions and to identify the opportunity. And if there is an opportunity, one takes it forward. If there is no opportunity, you tell them that you'll know pretty soon. So there'll be no time wasting in relation to that. But the value can be high. Okay, moving on to share options. Share options are a very useful way of tying in your key employees on the sale process. Once you've decided to go for the sale process, you know, you will want your key employees. You'll know who they are. How do you tie them in? Well, share options are a very useful way of doing that. The most common share option scheme for smaller companies is called the Enterprise Management Incentive Scheme, which I've already mentioned. It has several tax advantages, but the main one being that effectively these key employees can also benefit and share in the sale proceeds at a 10% rate of tax, even though they hold less than the 5% interest in the shares. So a very, very clever way of tying in your employees, making sure they're on board for the sale process. Finally, we've got the emigration from the UK, which is exclamation mark, question mark. It's kind of there as a little aside joke, but there are clients in the past who have said, well, I don't even want to pay 10% rate of tax, and they've gone abroad. All I would say to that is it's all very well, and it is possible to organise a disposal when you're abroad, but the practicalities have to be thought about. You know, how do you sell a company when you're not actually in the country to do so? Not impossible to organise, but can be tricky. And also, what is the taxation position in the country to which you move? So you've got to be very, very careful where you're emigrating to make sure that you're better off than the 10% rate that you would in the UK. And for that reason, not many clients actually do emigrate, although I have known one or two that have successfully done so and have paid no tax whatsoever. So it can be advantageous if you're prepared to move and fairly smartly. Brexit risks. There are Brexit risks, but we don't know what they are at the moment. Brexit really hinges around uncertainty generally in respect of sales taxation. We would hope that there would be a friendly business tax environment going forward, but you can never be sure. Philip Hammond is doing his first autumn statement next week, and on the 23rd of November, and we'll see what comes out of that, and we'll get a flavour of where the new government, or the new government's position is on that.
But our experience is it's creating some drag on the economy, which is forcing people to look at buying and selling companies in order to get shareholder value and growth. Is that what you're seeing?
Yes, absolutely. It is causing a bit of drag, and I would say because of the uncertainty, it's going to accelerate. It may accelerate people's decisions. In fact, I've seen this on 1 or 2 occasions. People are saying, look, there's too much uncertainty around the tax policy in this country now. I want to get out now whilst I can secure entrepreneurs relief. Okay, let's now look at the buyer's position. Similarly, we've split this into 3 areas, which is the planning process, the deal process, and post-purchase. But I'm not going to spend a huge amount of time on the buying issues because, as Kevin will know, there is a strong bias towards the vendor's tax position when selling a company. However, it is important that the buyer understands the vendor's issues and vice versa. So what are the main issues that would affect a buyer? And starting with the basics, one of the things that will affect buyers in the future is this TAR again. If a buyer is buying a new company or investing in a new company, when he has previously been investing in a company that he's disposed of within the past 2 years, he could be caught by the TAR. So buyers need to beware that they're not walking into a trap of their own making, and they may need to wait more than 2 years before they invest in what might be a similar trade that would be caught by the TAR in respect of a previous transaction. It's a nasty trap which buyers can fall into. But assuming all that's okay, it's a normal situation for buyers. What are they buying? Are they buying shares or are they buying assets? Typically, 95% of the case, they will be buying shares. So they will get no tax relief on those shares until they come to sell those shares, if ever. But the buyer also needs to be aware that actually if he were to buy the assets of the business, if it were an asset deal, then he could get tax relief, or the company could get tax relief on aspects of the business property under capital allowances. They could get tax relief for any stock that they're buying. They could get tax relief on the plant and machinery that they're acquiring via capital allowances. There will be no relief for goodwill, which was phased out last year. But there could be some upside from a buyer's perspective. But having said that, this is typically, I think you'd agree with this, Kevin, 95% deals, the vendor decides, and it's a deal breaker, isn't it?
Because we specialise in, sort of million to 50 million, it's almost 100% of deals.
Yeah.
So it's very much the smaller transaction end that that's what goodwill occurs.
Okay. But the buyer might want to use that as a negotiating tactic.
They try.
Yeah. The buyer also needs to be aware of tax due diligence, but remember you're buying a company because you're doing a share deal, probably. You're buying the company warts and all. It may have PAYE, VAT, corporation tax issues, and a history going back at least 6 years. Once you've acquired the company, these are your problems to deal with. Yes, you can protect yourself via judicious use of warranties and indemnities, but still the primary liability is yours, and you'd have to get the money back off the vendor if you wanted to invoke those indemnities. So do your due diligence up front. Most important that buyers do that and understand that the tax history of the company. Remember also that you are a seller of the future. So the structuring, and I'm thinking, bearing in mind that the structure we were looking at earlier, of the acquisition could be important. Do you put it into an existing group structure that you've already got? Do you acquire it separately because you're thinking of disposing of it separately? Is the acquisition of this business going to taint the nature of your existing businesses going forwards in respect of entrepreneurs relief? So all of these issues for a vendor are just as relevant for a buyer when they've acquired the shares themselves. So do think carefully about exactly how it is you as the buyer are going to acquire these shares. Watch out for employment tax traps for buyers on deals. Now, typically where this causes a problem is when a vendor comes across for a period of time as a consultant, or you have employees who were option holders in the target company, and they're exercising their options. Both the consultant and the option holders, when they sell their shares, may give rise to PAYE liabilities. These are your liabilities to deal with as the buyer if you're not careful. You do need to look very carefully at the structure of your sale and purchase agreement and your consultancy agreements and the way in which the option holders have been treated in the target company to make sure that you don't become liable for their PAYE and national insurance issues. It's something that needs to be dealt with before the deal is signed. Similarly, underclaim reliefs, which we've said to the vendor they should be looking at, the buyer should be looking at also, because the vendor might never get round to having a second opinion claim on R&D. There may be a nice little well of untapped assets and value in underclaimed R&D, and you can go back up to 2 years to claim that, even as the buyer. Similarly with capital allowances and losses. These are your assets once you've acquired them as the buyer. So it could add unexpected value to a deal. Finally, and this is not for buyers, this is where I think people get a bit confused with the new investors relief. Investors relief will not apply to people acquiring existing shares in a company. Investors relief will only apply to new value put into a company, in other words, new share subscriptions. So if you spend £2.5 million on buying the company, you will not get investors relief on that. But if you put another £2.5 million in by way of new capital, you will get investors relief on that £2.5 million. And similarly, anybody else putting in new capital into a company will also qualify for the investors relief. Okay. So we've done the situation, we've looked at the seller situation, we've looked at the buyer situation. Let's look at briefly at the post-sale situation for the vendor. And the first thing to be said is that you've gone out of the frying pan into the fire in terms of tax, because yes, you've got your entrepreneur's relief hopefully, and you've only paid $250,000 on your £2.5 million deal. Unfortunately, you're now not protected anymore under the inheritance tax regime. What was exempt before is now fully taxable at 40% inheritance tax. So you've got £2.25 million liable at 40%. That's £900,000 worth of inheritance tax you've now walked into, which you need to do something about if you want to pass on your wealth to your children, your partner, or whoever further on down the line. So inheritance tax planning comes to the fore. Secondly, you need to make sure that your compliance is right. You've done all this planning, careful planning. Do not unravel it by doing shoddy compliance and cutting corners when doing your tax returns. Make sure that the disclosure is correct and is bulletproof so that you're protected from inquiry going forwards. And make sure that the transaction that you perhaps got advance clearance on is the same as the transaction you actually did. Finally, you've got all this cash. You probably will need investment advice, and you will need tax efficient investment advice. You may even be able to defer some of those gains that you were prepared to pay, would otherwise be prepared to pay 10% tax on. You can reinvest in what are called EIS qualifying companies, enterprise investment scheme companies, and you can effectively roll over that gain and keep that money working for you instead of paying it over to the inland revenue. Okay. In conclusion, to wind up, Kevin, what are the main points? Sellers, Establish your relief entitlements at least 18 months before the sale. So do your planning. Take the required actions at least 12 months in advance so you're not caught out by the 12-month rule. Claim your unused reliefs. Ensure that the final deal structure works for you. Do not get caught out at the last minute by last-minute changes to the deal. Apply for any advanced tax clearances well in advance of the deal to make sure that you're not going to get caught out by something the revenue don't like. And finally, ensure that reporting to HMRC is done carefully. For the buyers, ensure you don't get caught by the new TAR rule. That's nasty for all buyers. And ensure you don't get caught by employment tax traps. Do your due diligence. Make sure you know what you're buying, warts and all. Look for those unused reliefs. There may be gold in those hills that is unknown to the vendor. And follow up on any warranties and indemnities.
It seems to me it's a very specialist area with potentially some very big pitfalls. But also, if you prepare early enough, it can be made simple. Would that be right?
Absolutely, Kevin, yes. It is most important, as I think I've tried to make clear, that particularly for the vendors, that you do your planning well up front and you identify any issues well up front. As I've already explained, the way in which the revenue looks at what's commercial and what isn't is often quite different to what an entrepreneur would consider to be reasonable or commercial. So if there is a problem, you need to know well in advance.
Great. Well, thank you, Mike, and thank you all for listening. We are actually thinking of doing a white paper taxation guide for M&A strategies. So if anybody's interested in that, can you please email av@avondale.co.uk and put in tax white paper. We'd love to hear from you. Thanks again, Mike. Much appreciated.
Yes, thank you very much, Kevin.